What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of January 2023. Happy New Year, everybody. By the way, I am feeling quite a bit under the weather. I'm actually a bit sick, so I apologize if I'm a little off in today's video, but I'm going to try to power through it for you guys. Anyway, back to today's video. In this series, I try to pick for you guys 3 new stocks every month that I think are trading on sale at today's prices for the long term. And to make things a little more fun and interesting, I specifically choose one low risk, one medium risk, and one high risk option to show you a little more variety of what's available out there in the market. Now, I will just say that right now the stock market has been performing extremely bad, crashing and just doing horrible in general. And of course, the macro economy is not doing too well either. So I'm not sure that there's much out there that really classifies as low risk, but I will pick something here that is at least lower risk compared to other stocks out there. And we'll see how I do. But I hope you guys are excited for this new list of stocks here for this month. And with that said, just please remember to do your own research, make your own decisions. I'm only sharing my opinion here and I'm trying to show you guys different stocks, so just kind of keep that in mind. But these are all stocks that I really like, so I hope you're still with me. It's going to be a fun one. Let's go ahead and jump straight into this list. All right, guys, and starting first here with our relatively lower risk option, I'm going to go with Disney, ticker symbol DIS. And I know Disney stock still carries a ton of risk, of course, so it may not seem like a great option at first glance. They're still heavily dependent on the theme park, resorts, and movie theater markets, which, if the pandemic has taught us anything, it's that these markets are always going to be at the mercy of government authority, who can really crash them into the ground during a disease outbreak like we've seen happen. In fact, the closure of their theme parks actually caused them to lose over $7 billion just in 2020 alone. And as if that wasn't enough of a headache for shareholders, the company is also known to get a little political, which not only risks alienating much of their fan base, but it's even hurt some of the special tax benefits that they would normally receive in the red state of Florida. Meanwhile, the company itself is in the middle of a giant transition where they are trying to focus more heavily on video streaming, and the result has been a shaky business with even a change in CEO recently, as they brought back Bob Iger, who was famous for overseeing the massively important acquisitions of Marvel and Star Wars, and has helped build Disney into arguably the most attractive media empire in the world in terms of at least content and IPs. The result of all this turbulence, though, coupled with a broader stock market crash, is that investors have fled Disney stock in droves, causing it to crash by nearly 60% from the top, leaving the stock now trading for one of the lowest prices that we've really seen in almost a decade. From here, though, is where I think comes a lot of opportunity to perhaps pick up what I think is actually a fairly low risk, long-term bet on a world leader of media and entertainment for one of the cheapest prices that we might ever see in the stock. In just a couple years, Disney Plus has already grown to over 164 million subscribers, and when you combine it with Hulu and ESPN Plus, Disney clocks in more subs than even Netflix at over 220 million. Not to mention every other video streaming player out there too, including Amazon, by the way, who practically gives their service away for free as long as you have a Prime account, but Disney trumps all of them. And really, the other day, I was looking up all the new movies and shows that are coming from Marvel and Star Wars, and I just can't believe how much content they're producing at a time when so much of the competition is, to be honest, lacking. I mean, just look at Marvel alone. They're bringing back the Daredevil and Punisher series that used to be a huge hit on Netflix. They're making a new Blade movie. They're expanding on the Kang the Conqueror storyline, even being implemented into the new Avengers movies. They're making another Loki season, which was also very popular. They're making an Agatha series. There's just so much going on there, and you even have a lot of other stuff too to follow up on in Star Wars, like with Mandalorian, Boba Fett, Obi-Wan, Ahsoka, and more. And by the way, I know that a lot of that content hasn't been very good lately. I'm a big critic of it. I was a huge fan of, Obi-Wan and Boba Fett, the characters, but I felt the shows were pretty bad, and I'm hoping that they'll improve on them. But I would just say that all of this stuff coming from Disney, it's at least something with big budgets and big entertainment value, while most other companies out there are just kind of sitting around, not really doing anything. Anyway, the point is that Disney is in a turnaround phase right now. And when you look at the valuation and the financials, I actually think that the stock is looking pretty cheap. Not only did they break a new record high for revenue last year, but they're still growing those sales by a high single digit percentage, kind of close to a double digit almost. And that's with already close to $100 billion run rate. And while transitioning, the business has weighed heavily on their profits. Their streaming services are all expected to reach profitability over the next year, which is why their EPS is going from a negative 22% average over the past 5 years to now a positive 23% growth rate over the next 5 years. And because the stock has crashed by so much, that growth is leaving them with one of the cheapest valuations you might ever see in Disney stock at a PEG ratio of way less than 1, which is a fantastic ratio. And that's why even the most bearish analysts today still have their lowest price target set to a higher amount than where the stock is trading right now. So I just think that if I give Disney enough time and I look at the stock from a long-term perspective, I just feel that it will recover and outperform. Of course, that's just my opinion, but it's why I choose to own this stock myself. All right, guys, moving on here to stock number 2. This will be our medium risk option, which I sometimes like to go with a dividend paying stock to help mitigate some of that risk by being able to collect an attractive dividend. And this month, I'm going with one of my favorites in Scotts Miracle-Gro, ticker symbol SMG, which is the largest marketer of garden and lawn care products in the entire world. Right off the bat, though, I have to say that Scotts is an even bigger turnaround. They're inside of a bigger turnaround phase right now than even Disney, which is why it's much higher risk. Because while 2020 and 2021 were record-breaking growth years for the company, thanks to the pandemic lockdowns that resulted in more people staying home and working on their home gardens and lawn care, it was really more of like a one-off type of event that was quickly followed up by a disastrous 2022 where they even experienced a loss on the bottom line. However, there are a few reasons why I believe this to be a temporary setback that will be followed by much stronger long-term performance. Number one, it was a very hard comparison to the pandemic years. Number two, there has been a lot of bad weather this past year that is decreasing demand for their garden and lawn care products, which, by the way, they've pointed to that numerous times in their earnings calls. And of course, now you even have a polar vortex making things even worse. Number three, there is an oversupply right now in the can market that is hurting their Hawthorne division. And number four, their expenses are too high in the face of rising inflation, interest rates, and a horrible macro economy. But I believe these issues will eventually pass. First of all, the difficult comparison to the pandemic years is basically behind us now. The bad weather can't last forever. The can market will not only balance out over time, but it may even see explosive growth soon from legalization in America, which I think is only a matter of time until that happens. And while the bad economy may linger for some time, SMG is at least addressing the rising expenses by cutting close to $200 million of expenses per year. And while you wait for the rebound to gather steam, you now get a stock here that has been absolutely destroyed into the ground with a record high dividend to go along with it. From the top, SMG has already lost over 80% of their entire value, leaving the valuation at a dirt cheap forward P ratio of 12, less than a 1 PEG ratio, and less than a 0.7 PS ratio. Meanwhile, the company is getting back on track with low revenue growth expected in each of the upcoming years, plus their profits are returning to growth as well, going from negative EPS growth over the previous 5 years to positive 7% growth in the next 5 years on average. And even analysts are starting to see the value return as it now trades right near the lowest price targets. Plus, the stock crash has even sent their dividends soaring to a mouth-watering 5.4% yield, which has also been grown for over a decade in a row and is currently sitting right near a record high. In fact, the dividend has never even risen above 4%, and many times has even hovered well below 2%, but now it's above 5. That's super attractive. In my opinion, is that it's not going to last. Being able to pick up SMG at this low of a valuation and at that high of a dividend yield has never really happened before in history. And like I always say, things can and probably still will get worse here for the economy in the short term. But over time, I might be looking at a historic buying opportunity here for SMG. And it's the reason why I've been buying quite a bit of this stock recently myself too. All right, guys, that's going to leave us now with the third and final stock, which is also going to be our highest risk option. And I know this has been a very bad performer, but I just can't stop believing in their long-term potential. And that is Teladoc Health, ticker symbol TDOC. And just off the bat, this is the American leader of telemedicine, and that alone should catch everyone's attention considering the pandemic we've been going through and the giant push by governments, giant corporations, and honestly, even consumers to make everything more digital, virtual, and remote. Personally, I'm not a fan of that. I'm kind of old school in that I like to see people in person and go outside and get fresh air. But when it comes to the health markets, even I'm on board with taking things more virtual. See, hospitals are notorious for attracting disease and illness because that's simply where all the sick people go. And so if you just need to speak to a doctor to maybe get a prescription or just get a quick opinion or get referred to a specialist, anything that doesn't require like immediate medical assistance, then why wouldn't you want to just do that virtually from the comfort of your own home and avoid the long lines, avoid the crowded wait rooms, the long wait times, the interaction with sick people, and especially if you're old or disabled, it's much more convenient to just speak to a doctor remotely. And for that clear reason, this is exactly what we've seen from both doctors and consumers that they've been asking for. They've been asking for this. And we'll get a little deeper into that in just a second because that's more of the long-term vision. But here in the short term, Teladoc Health, well, they initially experienced a giant surge in demand for their products and services during the pandemic, with sales skyrocketing by nearly 100% in both 2020 and 2021. The issue, though, is that coming off of the pandemic, demand has slowed way down. Now, mind you, it's still growing, but it's growing by a smaller percentage, only around 18% this year, and another 13% expected next year. And meanwhile, Teladoc has been investing so heavily back into the business, including, by the way, some giant acquisitions to ensure that they remain the market leader, well, that their losses have only gotten worse over time. However, just like the other two stocks on the list, this is where I think that the bad news mostly ends, as the selling in the stock by investors is, in my opinion, ridiculously overdone. From the top, Teladoc has now lost over 90% of its entire value. Guys, this is a stock that was once trading for over $300 a share and is now down to just $20. That's crazy. And valuation wise, you're now talking about a price to sales ratio that was once as high as almost 40, but has now crashed to just around 1.5. Considering the long-term growth potential, I think that's very attractive. Mind you, that the telemedicine market is also still expected to grow by over 25% a year, reaching almost $400 billion in just about 4 years from now. And TDOC, by the way, only did about $2 billion all of last year. So there's still giant room for expansion. And even longer term than that, surveys show that only around 2% of patients that tried telehealth were extremely dissatisfied, only 4% were not satisfied, and then 16% were neutral, 36% were somewhat satisfied, and over 40%, the largest amount, were extremely satisfied, noting the convenience and accessibility of it all. And like I said before, even doctors and physicians are also on board with it, as over 60% of them say telehealth is easy to use, over 50% say they felt happier at their job, and almost 70% said that they want to increase the use of it in their own practice. Look, I get it. Teladoc is very high risk because of the lack of profitability and the current market conditions. I myself only own around 1 to 2% of my portfolio in the stock because I'm afraid of going too heavy on it. But I just think that longer term, the profits will eventually come, and we're already seeing some sign of that as both their operating cash flow and even their free cash flow both turned positive this past year and are really only being weighed down by their heavy investments and capital expenditures that are eating away all of their profits. But I gotta believe that the market leader will eventually be able to balance out those expenses with rising profits from the economies of scale. And in the meantime, I just think that the stock is super cheap and even lower than the most bearish analyst price targets. Like I said, it's only a tiny position of mine, but I've actually been buying it pretty aggressively here, especially recently in the past week, because I just think that over the long term, I will be happy with my purchases, but we'll have to wait and see. Anyway, those are my thoughts, my opinions. I would love to hear what you guys have to say down below. Do you agree with anything I said? Do you like any of these stocks? Have you ever thought about owning them? What are your opinions? What other stocks do you like or prefer more? I'd love to hear your thoughts. Hope you're all doing well. Hope you're all having a great start to the year. And I will catch you guys in the next video. Take care, my friends. Bye-bye.